Namaste, welcome to Arthaniti tutorials. Today we will start with the first chapter of 11th standard accounting and bookkeeping. Now, this chapter is basically an introduction to accounting and bookkeeping. But before we start with the chapter, one thing that I want to share with you is how studies are going to change once you have come to the college. Now, for the last 13 years, when you were in school, the focus of your education was to make your basics strong, your subjects strong, right? Now, after the 13 years of schooling, when you have entered college, the next 5 years or 7 years till you complete your post graduation are going to concentrate on such kind of learning which is going to carve your careers later after you pass out of your colleges. Now, this learning is going to make or break your careers, correct? So, what line of education you choose, be it commerce or arts or science, the education that will be imparted to you in college will help you decide on the path that you want to take up next in your life. Now, even if you choose arts and science and not commerce, after you have completed your education, all of us aim to start earning money. Be self independent, financially independent, fend for yourself money wise. Correct? So, whichever profession you choose, you be a doctor or a lawyer or an architect or an accountant, say an artist, or you take up a job, become a salaried person, or start your own business. When the aim is to earn money, how you manage that money is a very important question. And accounting and bookkeeping comes in very handy. So, this subject, though it is compulsory for all commerce students for the next 5 years till you finish your graduation, basic knowledge of accounting and bookkeeping goes a long way in helping you manage your money well. What accounting and bookkeeping tells us, helps us, is to keep a record, to analyze those records, and to take decisions in such a way that money matters are resolved in a smooth fashion. Correct? So, now let us start with the first chapter. Now, see, any organization, take for example a shop. If you are owning a shop, or you are a professional and you are giving a service to your clients, like a chartered accountant or an architect, right? You give service to your clients. When there is an exchange, say, of goods from your shop to the money that you earn for the goods that you give, or the service that you give to your clients and the money that you earn in exchange, all these monetary exchanges need to be recorded in a systematic manner. Now, how they are recorded, what rules need to be followed, what all are the various books in which they are to be recorded, is basically the knowledge of bookkeeping and accountancy. Now, in India, if you see history, how these records, the various methods in which monetary exchanges needed to be maintained in the books of the business, was first mentioned in a book called Arthashastra. Now, this book was written by Kautilya, who was a minister in the court of Chandragupta Maurya. Now, in this book, which he had written way back many centuries in India, formed the basis on which monetary transactions were maintained in our country. The double entry system of bookkeeping, which is currently prevalent all over the world and which is followed in India as well, has its origins in Italy. Now, an Italian merchant named Luca di Bargo Pacioli uh, was the first one who introduced this double entry system of bookkeeping. He is rightly called as the father of double entry system of bookkeeping. Now, what happened is, initially businesses were focused on the sole proprietor himself, the area which he would target and be able to service his business was quite small. The number of people which were involved in his business was also quite small. In the 18th and 19th century, with industrial revolution taking place, there was a shift in the way businesses were undertaken. The scope of businesses widely increased. So what happened is, from a sole proprietorship concern, businesses became bigger, and ownership of the business and management of the business got segregated. In the sense, people who ran the business, who managed the business, were separate from the people who owned the business. Now, bookkeeping and accountancy came in very handy. Why? Because from the owner's point of view, he could check the books of accounts and see whether the managers that he had appointed to run the business were doing a good job. Was the business run successfully? Were there any mistakes which needed to be rectified? All this information was known to the owner by looking at the books of accounts. Likewise, the managers on their part also found these bookkeeping entries very useful. Why? Because they were able to take right decisions which were in the best interest of the company. Correct? In the 20th century, what happened is management accounting came into the picture. Now, analysis of the records that was kept in bookkeeping and accountancy started taking place. Going into the depth of the entries, looking at the financial results that the entries showed, and taking decisions which proved to be beneficial financially for the company was the focus of management accounting. Cutting cost, locating extra unnecessary expenditures was came into the purview of management accounting. By the 21st century, the focus shifted on social responsibility accounting. Now, since the industries were impacting the society on a very large scale, be it employees or consumers, yes, the industries had a huge impact on the society, and the social responsibility of the businesses gained importance later in the 21st century. So, this is how accounting was evolved over from history till date. Correct? Now let us move on to the next heading in this chapter, which is basically the definition of bookkeeping. Now, bookkeeping in simple terms means recording financial transactions of a business, recording transactions where money is involved in a business. Correct? So, bookkeeping is simply a comprehensive record of daily transactions where money value is involved. Correct? Now, these are the various objectives, features, importance of bookkeeping. These notes are available on my website. Now, if you wish to have these notes, please go on my website and click the related link and see how you can get these notes. Correct? See, basically with bookkeeping, what happened is all the transactions in a business where money came into the picture were recorded in a chronological order. Chronological order is date wise, so no transaction was left out. What happened because of this was management was able to control the incomes and expenditures. They were able to pinpoint incomes which were receivable but which were not received as yet, or expenses which were undertaken but which proved to be unnecessary or which proved to not add any value to the business. So, this analysis was possible only because of the first step of bookkeeping, which is basically keeping an entry of all the transactions. Correct? It was useful not only to the management but also to the investors to take decisions whether the company was worth investing in or not, whether the company was profit making or loss making. Who would invest in a loss making company and lose their hard earned money? Well, no one. So these records were useful for the investors as well. From the government point of view, the records came handy for the government to check whether proper taxes on the incomes that the business received were paid or not. Was any taxes are any taxes due? Did the company pay all the taxes which were due from them? All this is useful for the government to check with the financial records available in the business, right? Lenders like banks or financial institutions who give loan to the company check the financial health of the company on the basis of the bookkeeping records. Now, while giving a loan, what company, see, if you approach a bank for a loan, the bank is going to ask you what asset are you going to keep in lieu of the loan that you have taken. Yes, the bank has to recover the money that it has given you. Likewise, when the bank give loans to a business, it has to check for the financial health of the business. Is the company in a position to repay the loan, repay the installments, repay the interest? Correct? Because if that does not happen, the loan will become a bad debt, the loan will be overdue and the bank will lose money. Correct? Also, from a customer's point of view, a company with a healthy financial background is necessary. Why? Because to check whether the order which you have placed with the company is in a position to fulfill those orders, deliver those goods to you on time. So there are various stakeholders in a business, and financial records, accounting records come in handy for all of them, be it the owners, the management, government, lenders, investors, customers. Financial records is necessary for everyone to understand what they are dealing with, how is the health of the business financially, and take decisions which are in their personal interests, right? Now, difference between bookkeeping and accountancy. Now, telling you frankly, the first, before we go on to the difference, what we saw was the definition of bookkeeping, where I told you bookkeeping was record keeping. So, bookkeeping basically is the foundation. So, bookkeeping is basically the first step of accounting. On the basis of the records that are maintained in the books of accounts, analysis of those entries is done in accountancy. Accountancy follows bookkeeping. Correct? Now, the results of the bookkeeping process provide inputs to accounting. So, at the end of bookkeeping is where accounting starts. Correct? Accounting is just record keeping, bookkeeping is analyzing those records. Who maintains the books of accounts? A bookkeeper is the person who is responsible for maintaining the books of accounts, while an accountant is responsible for accounting. Bookkeeping is basically a clerical job, whereas accountancy is a job where you need analytical skills to understand and decipher the results from the bookkeeping process. Correct? In detail, the differentiation is available on in the notes or available on my website. Correct. We'll go on to the next part now, the meaning and definition of accountancy. Now, accountancy, what did I say? Starts where bookkeeping ends. It is the next step in the study of accounting. Now, as per Professor Kohler, accountancy refers to the entire body of theory and the process of accounting. What it means is classifying and analyzing business transactions as per the records kept in the books of accounts. That is what is accounting. Now, there are basically three methods of accounting: cash basis, accrual basis, and mixed or hybrid basis. Now, what is cash basis? See, basically, when actual cash is received or actual cash is paid, that is the only time when records are maintained or entries are passed in the books of accounts, is the cash basis of accounting. When actual cash is received and actual cash is paid, and those records are kept in the books of accounts, is the cash basis of accounting. Now, accrual basis of accounting is what? When something becomes due. Say, suppose you have to pay a bill which is due, but you have not paid it still. Cash has not actually gone out of your pockets, but the bill is accrued, the bill is due. When that happens, well, when the bill becomes due, you record the same in the books of accounts. That is called as accrual basis of accounting. Now, this not only relates to the expenses but revenues as well. Take for example, when a sale is done by a business on a credit basis, in the sense you do not receive cash immediately when you sell the goods. You have sold the goods on credit. You have not received cash, but you will receive cash. That income is due to you, but not yet received. It is accrued. That is when entries are passed in the books of accounts. When this method is followed, it is accrual basis of accounting, which is also called as mercantile basis of accounting. Now, the third basis is what? In this system, cash as well as accrual basis is uh, taken into consideration. What normally is done is, whatever incomes are supposed to be received, only when they are actually received in cash, that is when they are recorded in the books of accounts. And expenses, when they are accrued, when they become due, even if you have not paid them, that is when they are recorded. So receipts or revenues are recorded only when they are actually received, and expenses are recorded when they are accrued. They become due even if you have not paid them. But need not worry, hybrid system or this mixed system of accounting is not allowed in India by law. So we need not study it. So what we need to study is cash basis and accrual basis only. Now, quality of uh, qualitative characteristics of accounting information. Now, how is this accounting information going to help a business? See, there are basically four characteristics. Reliability. Why? Because whatever information these accounting books are going to throw is the basis on which decisions are going to be taken by the management. So the information has to be reliable, relevant. Only information which is going to make a difference in the company, for the company, is what is going to be recorded in the books of accounts. Which has to be recorded in the books of accounts. Why? Because information which is unrelated to the business is not going to make any difference in the decision making process. Comparability. See, what happens for this quality basically means is, if your business, say, is running for a period of 5 years and you want to compare the growth year on year basis, how has your business fared for the 5 years? If you have to compare this year's result with previous year's results and previous year's results to the year before that, the way you have maintained your accounts, say either on cash basis or on accrual basis, there has to be consistency in the way you have maintained your accounts, correct? If, say, 2 years back you were following the cash system of accounting and last year you started following the accrual system of accounting, this year you switched back to the cash system of accounting, will your data be comparable? Absolutely not. Your data will not be comparable. So comparability is one of the important qualities of accounting information. And understandability. Absolutely. See, even if you are a non-accounting person, even if you are a person who is not from a commerce or finance background, looking at the records, you should be able to understand simple results, say like profit and loss, or capital of the company, or creditors of the company. So such figures which are necessary for investors or lenders should be easily understandable, correct? Next, we will go on to important terminologies which are used in accounting. Now, these terminologies are going to be useful for non-accounting people as well. Let us look at them one by one. What is a transaction? The first term that we are going to study is transaction. See, transaction basically is any exchange of goods and services for money or money's worth. Any give and take where goods are exchanged for money, where services are exchanged for money can be termed as transaction. Transactions are of two types, simple monetary transaction and non-monetary transactions. Monetary transaction, we know we go to a shop, we buy something and pay money for it, monetary transaction. What is a non-monetary transaction? It is also called barter, where goods are exchanged not for money but goods. You give some goods and you take some goods, where non-monetary transactions are involved, which is not in practice in today's times. It was an age-old practice which was followed, and that system was called barter system of exchange. Correct. The next term, capital and drawing. Now, what is capital? Capital, telling you frankly, is the initial amount that the owner, the founder of the business, puts into the business to start the business. Correct. It may be cash, or it may be building that he has brought, or say computers that he purchased and started using for the business, right? Anything that the owner invests in the business to start it is called as capital. Now, from the business point of view, what happens is it becomes a liability. Liability is something which you have to give back. The owner has given this money to the business to start it. Correct? So, from the business point of view, that money has to be returned back to the owner when the business is getting closed. Correct? What are drawings? See, these terms are important when you start learning journal entries, ledger accounts. Drawings, capital, transactions, these terminologies will be frequently used, and you should understand the meaning of those terms. Correct. Now, what are drawings? When the proprietor or the founder withdraws, say, cash or some goods from the business for his personal use, that is known as drawings. Say, uh, I have opened a shop, a stationery shop, and I withdraw from that shop, say, a book or a pen for my personal use. I take it from the shop, I don't pay money for it in exchange, and I'm using it for my own use, not for the use in business. So, that withdrawal of a book or a pen that I have done will be termed as drawing in accounting terminology. Correct? Next, debtors and creditors. Very, very important to know. Never forget this. This is going to be these are going to be terms that you will hear and read in newspapers all your life. Correct? Now, debtors. Who are debtors? Debtor is a person who has to pay money to the business for buying goods and services on credit. Understood? Money is receivable by the business from the debtor. The business has sold. Say, suppose I have a shop, I sell some goods, say, to Anjali. Anjali does not pay to me right away for the goods that she has purchased. So the money is due from Anjali to my business. Anjali becomes my debtor. Understood? So the person from whom money is receivable to the business is called as debtor. Likewise, creditor, exact opposite of debtor, person to whom money is payable by the business. Say, I purchased some goods from a wholesaler so that I can sell it to my clients. Now, I haven't paid cash for the goods I purchased from the wholesaler immediately. So, what happens? Wholesaler is the person whom I have to pay money from my business. So, a person to whom the business has to pay for buying goods or services on credit is called a creditor. So, in the example that I gave you, who will be called as the creditor? The wholesaler who is supposed to receive money from my business. Money is due to be paid to him by my business. So, he becomes a creditor to my business. Understood? Right. Next, expenditures and types of expenditures. What is expenditure? Expenditure is basically spending, right? Now, capital expenditure. Here we had seen the term capital. Correct. Now, what is capital expenditure? Amount spent to acquire fixed assets to start a business, say, which are beneficial not only for a limited period of time but over a long period of time. Say money spent to buy a piece of land, money spent to construct building on that land, again money spent to buy machinery to start the production process. Now such expenditures mostly are once in a lifetime of the company. You don't go out and buy build land every month for your business. You buy it maybe once or twice in the lifetime of your business. Correct? So, such expenditures are examples of capital expenditures. Revenue expenditures, opposite of capital. Okay, what are revenue? Revenue expenditures are day to day business expenditures. Now, what kind of expenditures are day to day? Say salaries of your employees, electricity bills, your mobile bills, rent of the premises if you have rented the premise, are all expenses of a recurring nature. You have to pay it after every few days. That is the example of revenue expenditure. Now, this is wrong. This has to be deferred. Deferred revenue expenditure. What is this? An expenditure which is undertaken but the benefit of which can be enjoyed even after the close of the accounting year is called deferred revenue expenditure. Say suppose you have, I'm just giving you an example. You have a Tata Sky connection at home and you have paid for 2 years in one go. Why? Because you were getting some scheme and a discount. So you paid the money for the subscription for 2 years today itself. What has happened is the money has gone out of your pockets today, but the benefit of that expenditure you are going to reap over the next 24 months. Even though you have paid today, the benefit is going to be received by you over a period of 2 years. That is what is an example of deferred revenue expenditure. Right. Next, cash discount and trade discount. Again, very, very important, and you should know the difference. Now, what is a trade discount? A discount which is offered by the seller to the middleman is called trade discount. It can be given on cash as well as credit purchases. Now, what are middlemen? Do you know this term middlemen? Say, goods are produced at a factory of the producer from where a wholesaler buys those goods. Now, the wholesaler is going to sell those goods to a retailer, a retail shop owner, a kirana shop owner. Correct? The kirana shop owner or the retailer is going to sell it to consumers like you and me. So, who are the middlemen? The wholesaler and the retailer are called middlemen. They are a link between the producer and the ultimate consumers, which are you and me. Correct? Now, when, say, suppose a wholesaler is selling goods to a retailer and he gives a discount, upfront discount, say goods were worth rupees 100 and the wholesaler gave a discount of say 5%. So, 5 rupees he gave a discount. What happens is the retailer will get 100 rupees worth of goods at what price? He has got a trade discount of 5%. So he will get those goods at a price of 95. Understood? One thing that you should know is it can be offered on cash as well as credit purchases. And one more important thing that you should remember is trade discounts, no records in accounting entries. So, when you have trade discounts in any of your problems, you do not show it in your accounting entries. Cash discount, on the other hand, is offered by the seller to the ultimate consumer when cash purchases are done. So, cash discount is offered only when cash purchases, upfront cash is paid. So, cash discount cannot be offered when credit sales are effected. Understood? Right. Next, we'll go on to solvent and insolvent. Now, solvent, who is a solvent person? Simple, whose assets are more than his liabilities. What are liabilities? Dues, loans that he has, which he has to repay. So the assets that a person has are higher than his liabilities. The person is called as solvent. What are assets? Say a piece of land that he owns, cash which is lying in his bank, his investments are all assets. So in case the liabilities are due to be repaid, his assets are bigger in value than his liabilities. A person is called as a solvent person. Correct? On the other hand, who is an insolvent person? Exact the opposite, whose assets are less in value as compared to his liabilities. In the sense, when the loans become due, the person is unable to fulfill his promise, unable to repay back these loans. The person is termed as an insolvent person. We have many such people in India, but let's not go there right now. Correct. Next, accounting year. Now, all of us have heard of calendar, calendar year. Very simple, yeah, basic knowledge. It starts from Jan and ends in December. But what is accounting year? Is it the same as calendar year? Well, no. Accounting year, like calendar year, is also a 12-month period. But it starts from 1st April of this year and ends on 31st March next year. Correct? This is as per the income tax rules in India. Right? So, accounting year also a 12-month period, but which does not start on 1st of Jan. It starts on 1st of April. So, for 2022, calendar year 2022, what is going to be the accounting year? The year will start on 1st April 2022 and end on 31st March 2023. Correct? Next, goodwill. Now, read this. Goodwill is an intangible asset. Do you know the difference between tangible and intangible? This pen that I'm holding, I'm catching it in my hand. I can see it with my eyes. I can write it, write with it. Correct? Tangible. This is tangible. Correct? But I'm feeling happy today. I'm feeling sad today. Can you see my sadness and can you see my happiness? Intangible. So something which you can see, touch with your hand is tangible. Something which you just feel or you have an image about it in your mind, but you cannot see it, you cannot touch it, becomes intangible. So goodwill is an intangible asset. So what is goodwill? Basically, reputation of the company, reputation of the proprietors, the kind of goods the company is producing, marketing, selling, the quality of those goods, the quality of customer service. Correct? How is the company reacting to calamities that occur? Does it have any social responsibility that it has undertaken? All these factors together are clubbed to be called as goodwill. Now, say in India, if you hear the name, say Tata, or say you hear the name Reliance, you immediately come to know the people who are running the show, the kind of caliber, the kind of status Ratan Tata has as a businessman. Immediately adds to the goodwill of the company. Correct? You don't think twice. See, a few days back, I wanted to buy a bottle of water. I was traveling somewhere and I was carrying some bottle with me, but the water got over and I wanted to buy bottled water. So I went to a nearby shop and asked the shopkeeper to give me Bisleri. Correct? All of us know that bottled water is whatever the name may be on the uh, bottle that a shop owner will give us, we always want to ask for Bisleri. It has become synonymous with quality bottled water. Correct? So I went to the shopkeeper and asked him for a Bisleri. But he handed me over a different colored bottle which had some orange brownish name, brownish logo and brand name. And I said, what is this? Don't give me all this. Give me some known brand. Yeah, I don't want to risk my health. The shopkeeper told me, read, madam, read what is written on the bottle, read the name of the brand that is there on the bottle. It had the name of Tata, Tata Copper or something like that, new bottled water which has come out in the market. So even though the branding was not familiar to me, even though the color combination of the bottle was not familiar to me, when I saw the name Tata on the bottle, I readily bought the bottle saying that it is going to be a quality product and my health is not going to be at risk. Correct? So that is what is goodwill. It is uh, recorded in monetary terms for accounting purposes. So it is very much part of the books of accounts. Right. Next, profit or loss. Now, what is profit or loss? Simple. When your selling price is more than your cost, what you are earning is more than what you are spending, you're going to earn profit. And subsequently, when your earning is less than what you are spending, what are you going to do? You are going to suffer loss. Simple. Asset, liabilities, and net worth. Now, assets. Any physical property owned by the business that has monetary value is called an asset. For example, say building or computers, land and machinery are all examples of assets. Fixed assets. See, some time back we spoke about capital, we spoke about capital expenditure. Fixed assets come into the same category. Assets which has an outflow in bulk. You have to pay a large sum of money to buy that asset generally, and you reap benefits from those assets over a long period of time. Are fixed assets. Land and building is one example. Current assets. Current assets have a maturity of less than 1 year, okay, which can be easily liquidated. What is liquidated? Converted to cash. So debtors, cash in hand are all examples of current assets. Fictitious assets. See, fictitious. These assets are not tangible. They do not have a releasable value. Deferred revenue expenditure like advertisement is an example of fictitious assets. Correct. Let's go to liabilities. What are liabilities? Liabilities are dues which you have to pay to the other person. Fixed liabilities, say you have taken a loan from the bank, you have to pay EMI every month. That is an example of fixed liability. Current liability, say bills due or creditors, you have purchased something on credit and now you have to pay the money due to the creditor. Current liability. Like current assets, current liabilities also have a maturity of less than a year. Right. Net worth. What is net worth? Net worth is excess of assets over liabilities. It includes capital plus reserves. Just remember this, net worth is excess of assets over liabilities. Right. Contingent liabilities. What is contingent? Which has not occurred still, but there is a risk that it might occur. Say suppose the company, there is a lawsuit in the court of law and the case is ongoing. But in case the result of the case is not in favor of your company, then you will have to pay the whatever the settlement amount is. That is an example of contingent liability. The liability is not due, but there is a possibility that the liability will become due in future. That is what is a contingent liability. Next, accounting concepts. See, business entity. Now, this concept is when you are going to pass entries in the books of accounts, always remember that you will have to do it from the point of view of the business, not the owner, the founder, or the proprietor, from the point of view of business. Say, suppose I have a business by the name Arthaniti. Yes. So, while passing entries in the books of Arthaniti, I am going to look at the various transactions from the point of view of Arthaniti, not Shefalika Gokhale, who is the owner of that business. Correct? So, my business Arthaniti is separate from my personal identity. That is what is the meaning of business entity. Money measurement. Now, according to this concept, what transactions can be recorded in the books of accounts? Only those which can be measured in monetary terms. Only those transactions which have money value can be recorded in the books of accounts. Now, cost concept. What does this mean? Now, an asset is recorded on the basis of its acquisition or historical cost. Say suppose you purchased a computer. Now this what do I say? The printed price on the computer say is 40,000. But the since you purchased in bulk, say you purchased 10 computers for your business, and the shopkeeper gave you a discount. Say instead of 45,000, which is the printed price of the computers, you bought the computers at 42,000 rupees each. So what entry are you going to pass in your books of accounts for these computers that you purchased? Your acquisition cost is 42,000. That is the historical cost on the basis of which you will pass entries in your books of accounts. Now, year after year, when you start using this computer, the value of the computer is going to get depreciated because of constant use. There is going to be wear and tear, which is called depreciation, which we will see at a later stage. No need to worry about it now. Now, consistency concept. I told you when we studied cash method and accrual method of accounting and comparability as a qualitative characteristics of accounting information. What did I say? Consistency is the key. Yes, means what? Any method of accounting that you are following, be it cash or accrual basis of accounting, you have to consistently follow it year after year. Why? Because of that consistency, your data becomes comparable, your decision making becomes easy, right? Conservatism. What does this mean? What is conservatism? Well, it means recording transactions. Anticipated losses should not be taken into account while all possible expenses should be provided for. It is basically playing safe. Whatever is due, even if we have not paid for it, should be recorded. Correct? That is playing safe. Playing safe. Correct? Now, going concern. What does going concern means? Going concern means your business will go on for eternity, for a foreseeable future period of time till you decide to stop it. That is what is a going concern. Realization. What does this mean? Revenues and incomes are recorded only when they are received or are accrued. Correct? So what happens is revenues. I might earn this much. I forecast that my business will earn say 10% more than what my business earned this year. It is just to forecast. But when you have actually sold, even though you have not received cash for it, that is accrued and that needs to be recorded. So only on realization basis, your revenues and incomes need to be recorded. Accrual I have already explained to you. Now dual concept. What is dual concept? See, any entry. Now a simple example, that you are selling goods for cash. Say you sold goods worth 5,000 rupees for cash. Now there is going to be two effects. There are going to be two effects for this simple transaction. Goods are going to go out of your business and you are going to receive cash. So dual effect. Correct? What is the transaction? Cash sales. Correct? With 5,000 rupees. Simple, but that simple transaction is going to have twofold effect. One, goods are going to go out of your business, and the second effect is cash is going to be received by you for the goods that you have sold. So any business transaction is going to have dual effects. Disclosure. What is this disclosure? Disclosure is basically the information that your books of accounts is going to show should disclose material, important information which is related to your business. Materiality and matching concept. See, I told you material, again, important information needs to be disclosed by the books of accounts. And what is matching concept? Take the previous example where cash sales of rupees 5,000 has occurred. So with matching concept, what does it mean? Goods worth rupees 5,000 have gone out of your business. Likewise, the same amount of cash, 5,000 rupees of cash has been received by your business. So 5,000 worth goods going out and 5,000 rupees cash coming into the business. This is what is matching concept. Now, accounting standards and IFRS. Now, basically, what are accounting standards? Well, they are codes of conduct or laws set by professional bodies so that accounts can be maintained as per these laws that are set. Correct. Now IFRS stands for International Financial Reporting Standards. Who has issued them? International Accounting Standards Board has issued IFRS. What do they say? Basically, how transactions are recorded in the books of accounts. Now in India, who prepares and publishes the accounting standards? Well, the Institute of Chartered Accountants of India, Institute of Chartered Accountants of India. Now what has happened is, in India there are many multinational companies, foreign companies who have opened shop in India, likewise Indian companies who have branches, say in various countries outside India. Now, for accounting records to be compatible with accounting standards in India as well as international accounting IFRS standards, what the Institute of Chartered Accountants has done is they have formulated IND AS. Now, this is basically international accounting standards modified to suit Indian conditions. Correct? Now, presently, all big companies who have multinational presence follow IND AS. But over a period of time, even the smaller companies will follow this. Correct? There are various accounting standards which we'll see at a later stage of our study of accounting. Just a few examples. AS1 relates to disclosure of accounting policies and companies. AS6 relates to depreciation accounting. AS13 accounting of investments. AS22, AS is what? Accounting standards. So AS22 accounting for taxes on income. These are the various accounting standards. So this in detail was what is the first chapter. This gives you an idea of what you are going to study in this subject of bookkeeping and accountancy. Correct. So I hope this is clear. If you have any doubts, I do take personal coaching. For any queries, any doubts that you have, please go to my website and check particular links and see how you can schedule an appointment with me. Correct. Thank you.